So today we're going to talk about stocks at a all-time high with P ratio above 30 and still have room to grow. Should you buy in those? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well. I am with my co-host Véronique, and today we have a more technical topic. So I hope that you're ready for this one, Vero.
I am, Mike, because you know what? We keep on talking about volatility and bad market news and all that stuff, but the truth is, many stocks are at the all-time high, which makes buying decisions harder for investors. So today, we'll see how valuation, especially P ratio, can help you avoid paralysis.
Yeah, I keep saying people, they have money on the sideline. They see like stocks that are overvalued. And I get the point. You want to buy at the lowest possible and sell at the highest possible. And you look back and you're just like, yeah, I mean, that was a good price 10 years ago, but now today's a bad price. Personally, I'm not a fan of valuation methods, mostly because they're all based on a crystal ball. Like no matter how you want to shift it, it's all about assumptions and expectations. And then when people are saying, yeah, I'm going to wait until that stock trades at like $45. And I always ask them like, why not 43 and 82 cents? And of course, I'm having fun, but that's the whole point. Like, why 45? Like, that's just the number that you're pulling out of like a calculator. Yeah, that's fun, but you need a little bit more. And ironically, most of my best performing stocks were bought at crazy valuation, meaning trading at a all-time high with P ratio that doesn't make any sense. And I can name a few just to start the adventure here. Costco, Constellation Software, Automatic Data Processing, Microsoft, National Bank, Couche-Tard, Visa, and so on. And it's kind of ironic because I bought them. Most investors told me at this point, at any points when I do those little trades, Mike, I get that you like those companies. They're amazing. They have great business model, but you're overpaying for those. And yet they're all more than 100% return in my portfolio. So kind of ironic, but anyway, this is why we decided to do this episode on which kind of metrics you can use that are linked to valuation so you can make better decisions.
All right, so Mike, let's take like just a step back. P ratio is often used to determine the valuation of a stock, but how does it work?
Yeah, it's kind of funny because it's one of my favorite metric to determine if it's worth to get in or not. And it's a classic valuation metric. So the P ratio stands for like the price earning ratio. So think about how many times you pay the profit per share. So a P ratio of 20, for example, means that you're paying 20 times the earnings per share. So it's just a multiple of how many times it would technically take for the company to generate profit, the price that you paid for it. It's an interesting metric because you can have it throughout the entire time. And it kind of makes sense because if the earnings per share increase, well, technically you should be paying more if you want to maintain the same PE ratio. So it's a good indicator if it goes up or it goes down, you have the same valuation, and then you can rank them and compare other companies like this. So easy metrics to calculate and easy to put in a table so you can make those comparisons.
In recent months and years, we have witnessed a phenomenon known as P expansion. What is it?
So P expansion is when you're ending up paying more for the same stocks. So if a stock price goes up and the earnings per share goes up accordingly, you have the same P ratio. So for example, you have a stock that trades at $100 with $10 earnings per share. That gives you a P of 10. So if the EPS goes up to 20 and the stock price goes to $200, you're essentially paying the same valuation. So it's still a P of 10. So at this point, it's just normal. You're paying more. The company's making more profit. Everything is normal. And it's not because you're paying $200 that you're paying more for the stock. Actually, it's exactly the same thing. But if the stock price goes up to $200, but the earnings per share remains the same, so remains $10, the P went from 10 to 20. And this means investors are willing to pay more than they were before. There must be a reason, of course. No free lunch in finance, right? But the reason is not necessarily backed by numbers. So the thing is, you can believe that this company is about to go through a breakthrough. There could be some speculation. Maybe it's just like investors are going into a crazy bull market. So they're just into FOMO. They're just willing to buy anything that is trading on the stock market. So therefore, if you have a higher demand than the offer, you will have to pay a little bit more, and then you pay a premium. Artificial intelligence could be a good example. Now, in a sense where you have AI companies that doesn't necessarily generate tons of earnings per share right now, tons of profit, but investors are willing to buy those stocks right now, thinking that in like 3 years and 5 years and 10 years, it's going to explode. A good example of that would the PE ratio for Amazon several years ago. At one point, it was trading at like 200 PE, like 200 times the earnings. So, in other words, you're paying a lot for not much profit. But the rationality behind that is now, right now, it doesn't look at their profit. They're looking at their growth. So they're reinvesting. They're willing to increase their expenses for that. They're spending more everywhere. So, of course, they're not making profit, but it's for the future. So it is just purely speculative because on the other side, Amazon could have been a big flop and not being able to generate more profit down the road. So eventually it's going to catch up to the business. You're not going to be able to trade at a 200 times valuation forever, but it could last for a good time. Fast forward today, Amazon has a better PE ratio, like around 30, 40 times the earnings, still high, but not crazy high as 200.
Now, could you like give us examples of dividend stocks showing high P ratios?
Yeah, there are a lot of like good classic examples. So we're going to start today with Visa and Costco. Why? Because they have been known to trade at what we could call crazy valuation or crazy PE
Mm-hmm.
ratio. So right now, Visa PE ratio is at 34. And now I'm going to introduce another term. The forward power PE ratio is at 30. So the forward PE ratio is based on expectation of where the earnings should be in the next 12 months. So it's telling you, okay, so right now you're paying 34 times the earnings, but if earnings keeps on growing as expected, and of course now for 12 months, the target is relatively accurate in a sense that management is giving you a hint with their guidance. So they're telling you we are expecting revenue growth of this, earnings per share growth of that. Analysts are doing their own calculation on their side, looking at financial statements and their narratives. So, long story short, you're paying a little bit more today, but in 12 months from now, as the stock price remains the same, the forward P ratio is at 30. Still, you're going to say, well, 30 times the earnings, it sounds like a lot. And a lot of
Mm-hmm.
investors, they don't want to go above 25, even sometimes 20 times the earnings. They want to keep it closer to the average of the P ratio of the S&P 500. Definitely at 30 or 34, you're way above that average. Now Costco is even worse because Costco is trading at a P ratio of 53. That's kind of crazy. And the forward is not that better. It's 52. So definitely you have to pay a lot for each dollar of profit in those two cases. But it has been the case for several years, which is mind boggling. I mean,
Mm-hmm.
I was sitting on the sideline for Visa for a while, and since their IPO, they were always around 30 times the earnings, anyways, and eventually bought it in 2017, pretty much at the same PE ratio it is today. And then, boom, the stock kept on growing its earnings per share. So we do not have a case of PE expansion. The PE expansion at one point could be dangerous because if you keep on buying a stock at a higher valuation over and over and over, well, the only thing that justifies the higher price, it's that speculation. No
Mm-hmm.
numbers, nothing else. Eventually, the numbers will have to come in, or what's going to happen on the other side is investors are going to say, well, the narrative was wrong, the numbers are right, and now we have to sell this stock because it's not worth 50, 60, 70 times the earnings. It's actually worth maybe 30 times or 20. And then you see the stock price going down big time. So P
Mm-hmm.
expansion for a short moment, or because there's a reason behind it, it could be good. But one way or another, you'll have to bring those numbers in to justify that expansion.
But then, how do we know if there are good investments or if they are just too pricey?
So this is where I use the average of the P ratio. And this is what I like so much. So I don't care about the P ratio per se. So Visa's at
Hmm.
34, Costco's at 53. I don't care about that. What I do care about is the average of the past 5 years and the trend over the past 5 and 10 years. By that, I mean the stock market investors, as I said with for Visa, they have always been willing to pay kind of like a premium, like 30 times, 35 times the earnings. Why? Because the company has a robust business model. It generates ton of cash flow. It has debt under control, and revenue and earnings keeps on growing. So it only makes sense that you're paying a premium for this one than you would for, I mean, it's like buying an iPhone today or an old BlackBerry. Of course, the iPhone 17 is going to be a tight, uh, like slightly more expensive than buying a BlackBerry from 2007. But there's a reason behind it. I mean, the quality is there, and this is why it's not that bad. So if you look at the average for Visa for the past 5 years, we're at 36. And in general, if nothing happens in the environment and in the business model, the stock will trade at about the same level. Of course, you're going to
Hmm.
have like crisis or bull market where the P ratio will fluctuate. So you always have to put that number into a context and understand what's happening in the overall market at this point. But as you can see, right now you're paying 34 for Visa. The average of the past 5 years is 36, pretty much aligned. So you're not getting a deal right now,
Hmm.
but you're not necessarily overpaying for Visa. It's just trading at the usual valuation. Now, of course, that comes with some obligation. Visa has to keep on reporting good numbers because at one point, if Visa would change and say, oh, well, in 2026 or 27, we're going to grow our revenue by 2% and earnings are, per share are going to remain flat, you can rest assured that the P ratio is going to drop because the stock price
Hmm.
is going to drop. Now with Costco, it's a different story. So the average is at 44. If I use the forward P at 52, I divided by 44. Now I have a 18% premium. So 52 divided by 14, that makes 18. So 18% PE expansion or premium. So at this point, you have to make the decision of can Costco can continue to bring that stability in terms of growth, like same
Hmm.
stores growth and opening new. Because the thing with Costco is it has a lot of potential to open new stores. We're actually desperately wanting one around Granby. So Costco, if you're listening to
I
me,
want one
please. Like,
too.
but jokes aside, the expansion, the premium is really based on future growth. It is what I like to call price for perfection. So if Costco fails, it would not be surprising to see the stock price going down by at least 20% just to bring it back to its average. So it's kind of hard to make a decision when you look at a
Hmm.
stock like this. It makes a lot of investors uncomfortable, and I totally get it.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. All right, so let's illustrate your view in more depth by also giving examples of stocks with low P ratio.
So for the low PE ratio, I wanted to highlight two companies that I have in my portfolio, but they're not necessarily relatively low versus their average. But if you compare Visa and Costco at like 36 and then 34 and 53, when you look at Canadian Natural Resources at 11 with a forward ratio at 12, you're just like, oh my God, that's a huge deal. Why would I buy Costco when I can buy CNQ, which is like 1/3 of its valuation?
Mhm.
A lot of investors makes that mistake. There's absolutely no link between payment processor growing double digit and an integrated oil company. Like that has nothing compared. And one thing that is important at this point is not just looking at the P ratio as a metric, but again, comparing it to its average. So not too long ago, CNQ was trading around 12 to 15 times the earnings. And the average is tricky for CNQ, mostly because if you look at the past 5 years, you're still integrating the first months of the COVID, where,
Mm,
and actually 2020, 2021, P ratio was completely out of the roof for
right.
CNQ because, I mean, the oil barrel went into negative pricing. That's kind of crazy. But this is what happened. So you cannot really use the average. This is where having the trend in a graph is more useful. But for the past 2, 3 years, it's around 12 to 15. Right now, it's 11. Seems like a good deal. But again, it's not an amazing deal versus Visa. You have to compare it at least against its peers and its industry or itself so you have a better idea. The other one I want to point out is National Bank, 14 times earnings payout ratio, so 14 times the earnings. So P ratio of 14, forward P at 13 looks like an amazing deal, but on average, Canadian banks usually trades around 10 to 11 times the earnings. So
Mhm.
ironically, National Bank at 14 P ratio is probably a worse deal than buying Visa, mostly because it should trade and its average of National Bank over the past 5 years is around 11. So it should trade closer to 11, not 14, which is a decent premium, versus Visa trading at 34 times the earnings, but the average at 36. So see
Right.
how it could be confusing if you look at across the board or you compare. And of course, now you're just like Visa is in the financial industry, in the sector, National Bank as well, but National Bank is a Canadian bank. And
Mhm.
then Visa is a payment processor, so they're not really linked in terms of like they have like different industries, different types of valuation. And again, more context will help you understand those principles.
Okay, so talking about low P ratio, how to make the difference between good deals and bad investments.
Yeah, so just looking at the P ratio, as I said, it's definitely not enough.
Mhm.
And for an example, I could say, well, I have a pretty good deal for you, Vero. Well-known brand in the US, retailer, big retailer actually, and trading at the amazing deal of having a P ratio of like 6.7. The forward P ratio is at 7.5. So it's crazy, right? I mean, we should
Right.
like
We should
remortgage our
all buy
house
it.
and like load the truck. But if I tell you that there's declining revenue, and declining earnings. And the company has been struggling for a while right now. Now it becomes a bit less interesting, right? And
Right.
for those who have not guessed it, I'm talking about Macy's. Macy's used to be a major retailer, now having a lot of problems. And you can see that when you look at the dividend triangle. You see the clear trend of like revenue declining, earnings per share declining. And this is why it trades at such a low P ratio. It's because investors, they don't care about Macy's anymore. They don't want to
Mhm.
buy it. So it's not a deal. It's just that people are not interested anymore because the company is struggling. So that's a key point where you may be thinking, oh, I'm a value investor. So paying like 6.7 or 7 times the earnings, that totally makes sense for me. But if the company keeps on going down, it's not going to help you. I love that old example of like BlackBerry back then when it
Mhm.
was about to get eaten alive by Apple. BlackBerry was trading at a P ratio, I think, between 4 and 8. They had no debt, 4 billion in cash, and yet investor knew. They were just like, this company is gonna just get eaten alive. And this is what happened. So yes, sometimes you're gonna find companies that will find a miraculous way to turn things around. And that was like the best price ever, buying it at 7 times the earnings. But that is like the stories that you tell at your Christmas party. It's like when I go golfing and I just remember like the 2 shots out of like the 110 I did. Yes, I have at least 2 good shots to talk about, and I'm just going to forget about all the balls in the woods or in the lake or whatever. And that's the whole thing. So you have to be careful about low P ratio and actually ask yourself why nobody wants to buy it, because all the information is public these days. So there must be a reason. I mean, it's not because you're the only smart investor in the entire world. Maybe a couple of them just watched the news and reviewed the earnings and realized that this company is going nowhere.
So, Mike, now we also hear the expression like all time high all the time. What does it mean, and why are you not that afraid of it?
Yeah, well, all time high, kind of crazy because over the past few years, since we are running in this kind of like never ending bull market, every quarter almost, we have a new high for stock price, meaning that a stock that used to trade at $100 now trades at 125, and then 3 months later it trades at like 140, and then 3 months later it's like 145, and then eventually 175, and then you're just like, man, this thing never goes down. And of course, one day we're gonna have a correction, that's gonna be fine, but it's just an anchor in time. So it's what you see up to date, right? And the problem is usually that we don't know the future. When I started my pension plan portfolio, it was in 2017 that I received the check. We did a full episode last week about that. So if you want to go back on the podcast, you're going to learn more about it. But that was interesting because I invested my money at the all-time high. Back then in 2017, it was the highest valuation for most stocks. Like there
Mhm.
were nothing else. So back then it was kind of like scary. You look at the market just like, yeah, I'm buying at the like the peak, but 2017 peak today looks like an amazing deal actually.
Right.
So we all wish we could go back to 2017 and buy more. And ironically, the best time for me to invest was when I started. And when I started was in 2003. But if I had started in 2005 or in 1999, that would have probably, well, 1999 would have been a rough year after that because there's the tech bubble. But most of the time, unless you're really unlucky and you buy right before a major crisis, today is usually the best day to invest, even if you're at all-time high. And as I said earlier, I remembered a lot of people talking about National Bank. $100 was the all-time high back then. Was way too much to pay for National Bank. And then today, as it trades around 150, we would say, oh, 110 is an amazing deal. Well, it's just because we anchor the price and time. So now that we see that a stock trades at 150, 110 is an amazing deal. But when it was trading at 100, 110 was like ridiculously high. So it's just a perspective. So that's why I
Mhm.
don't really care about the all-time high, because this is just the point in time that we are right now. And we don't know what's going to come up in the next 25 years. So I don't really care about what just happened because I'm holding those stocks thinking I'm going to have them for several decades in my portfolio.
And again, I mean, it's just a number. So the average P ratio should tell investors if the company is only priced for quality, right?
Yeah, this is what I like about looking at the average and the trend, because sometimes you're going to see as well, if you see that the P ratio keeps on increasing year after year after year, you have a good case of P expansion, and then it's an indicator of like, if you cannot understand why investors today are willing to pay more for the same earnings than they were 5 years ago, well, maybe you should walk away, because if you can't understand it, that's fine. You're a little bit
Mhm.
more aware of the risk. But if you have no clue, just go away. Same thing if the P ratio keeps on going down and you don't understand why. Again, it's because you do not grasp the business model correctly. Because if all investors are thinking the same, I mean, maybe they're all wrong, but it's kind of rare. Yes, you're gonna
Mhm.
have like a few exceptions all the time, and I mean, it's the same thing for everything in life, right? There's no like perfect rules, but following that indicator, it's a good way to know if you are aligned with the rest of the market or if you're overpaying. And if you're overpaying, you need a reason.
Okay, so let's now discuss maybe the most complex situation, skyrocketing stocks. Like this happens when you have a combination of pretty much everything we've mentioned so far. So P expansion fueled by hype, high P ratio fueled by a big potential, all-time high, and all this in record time. So what should we do in this situation?
Cash and run. No. When that happens, I usually say that those companies are priced for perfection. This is an expression that I've used before today, meaning that the expectations are so high for this stock that there's only one solution for them, is to keep on reporting amazing numbers. So if I love to, and I miss hockey, so, and I love hockey analogy. A good year for Suzuki this year would be 90 to 100 points, because his ceiling, like the highest point was last year, was at 89. So if he racks up like 100 points, going to be amazing. That's the expectation that we have for Nick Suzuki. But if we're looking at McDavid or McKinnon and they rack up like 100 points, I mean, we're going to be disappointed. That we're going to, especially if they're healthy the entire season and they play like 80 games, that would be a big disappointment. So we expect them to rack up a lot more points. So same thing for stocks. So when this happens, when you see that you used to pay 20 times the earnings, now you're at like 55, and the stock price keeps on like doubled or tripled, so you're just like, wow, big P expansion there. You need to first do a deep analysis. You need to understand what's going on. You need to understand like what's the business model, this amazing growth opportunity, and what's the likelihood of keep on reporting great numbers. For a larger business, a larger market cap business, it's scary, but I can buy in thinking maybe in the next 3 years I'm not going to make much money or I'm going to be negative, but for the long run it still makes sense to have in my portfolio. And again, I rather invest today than wait on the sideline until Microsoft trades at $75 again. It's not going to happen unless they split. So I would be more cautious though for small caps, because usually we're going to see this kind of trajectory where they go into a breakthrough, they double, triple, quadruple in value within like a few years, and then it's the big hype. Well, you have to be careful with that because it could go
Hmm.
up very fast, but it can go back down as fast as well. So for those, it's really a matter of like, what's the percentage of your portfolio you would allow into speculative plays? Like, are you willing to lose money on those big growers? And sometimes you're just going to buy one and it's going to continue to grow and you're going to be super happy, and kudos to you. But I prefer always to assess the risk first and determine if I'm willing to lose money on those, because this is what we're talking about right now. Like, there is an obvious risk that is not even related to the business, but just related to the price you pay. And this is where I agree with investors when they say you want to buy it at a good price. Yes, the problem is always what's a good price? And
Hmm.
then we can debate for 10 hours on this. But when you have a case of P expansion in the all-time high market, then you might want to be a little bit more cautious, because there's a lot of factors telling you that if the company does not continue to grow and meet analyst expectations, it's going to fall quickly.
Mike, let's also add like a perspective for people who are close to retirement or maybe already retired, because you're still in your 40s. You can, like you've said, you can manage paying all-time high. You don't have a problem with that because you're in for the long run. But what about those people closer to retirement or closer to withdrawals?
There is a big misconception that if you are about to retire, you should be a lot safer. And the thing is, your emotions, you could like think that you're going to be more stressed because you do not have this, oh, I can invest for like 50 years or I cannot add capital. But in reality, unless you are like 75, well, that's not really a problem because you're going to be in for multiple economic cycles. If you're like 60, 65, even 70, I mean, life expectancy is like around 85. You could go up to 80 to 90, 95. So therefore, you're going to go through a lot of bear markets and a lot of bull markets as well. And I get you have this stress that is going to come up. And if you cannot sleep at night, I mean, you go back into fixed income and you just accept that you're going to make less money out of stock
Hmm.
market for many people. And it's all good as well, because the best investment solution is the one that helps you sleep well at night, not the one that generates the highest return.
Hmm.
So right now we're at a all-time high. I would definitely tell people that are stressed about their portfolio, why don't you just review your strategy? But don't review it because we are at all-time high. Review it for the next 5, 10, 15, 20 years. And sometimes we have this question during private webinars at DSR, where I do have members in their 70s or getting close to 80. And they're just like, yeah, Mike, I get that. The whole thing is true when you're in your, even in your 60s. But now I'm just like thinking I may have about 10 years to live. I still want to invest because I love it. It's kind of my hobby. But I'm also conscious that I may like pass away and we would be in the middle of a bear market. So what should I do in this case? So I'd say two things about that. The first one is, if you have that much money at this point in your life, you might want to start thinking about the next generation. So where
Hmm.
that money is going to go. So maybe you just want to keep the same strategy, as this money is going to survive you. So you might as well keep on managing the right way. Or if you want to keep this fun part of like, I have a hobby. Well, why don't you just take a smaller portion of your portfolio that you keep managing and the rest you put it safe? So
Mhm.
you're still going to have the same fun. I mean, if you have $1 million, you can play around with 100 grand. You're going to have the same fun of like watching earnings, watching the market, reading the news, listening to podcasts. It's all
Mhm.
going to work. It's all going to be the same thing, just not the entire portfolio. And the rest could be invested in like safer stocks. Of course, when we look at P expansion like this, to get back to the topic, I would probably not necessarily put most of my money into like high P ratio stocks, like flying high and everything, because that doesn't make much sense anyway as a strategy. The key remains diversification. And while I will be retired, I intend to keep exactly the same strategy as I have right now. So chances are many of my stocks will trade at P ratios that are closer to 30 than closer to 15, but I will have a cash reserve. So for the bad years, I'm just going to withdraw money from the cash reserve. And on the good years, I'm just going to sell those apparently overpriced stocks that keeps on reporting great numbers and keeps on performing, because I
Mhm.
want to have a team of winners and performers in my portfolio. I don't want struggling companies that looks like a good deal, but they're just broken cars.
Okay, Mike, so let's go back to those stocks priced for perfection. Do you have examples of them that you would still consider buying?
Costco, definitely. We discuss it. This one, it's a bit uncomfortable right now, but I still like the narrative around it. The point of Costco is their business model gets only stronger as they grow. They benefit from huge economies of scale, and the more they open stores, the more they have economies of scales, the more they're profitable, and they keep that virtual cycle goes on. As long as they are able to run that playbook, I'm in for the long term for this one. And I have no intention of trimming, even if it looks, seems, whatever you want, overvalued. Another one that I never ended up buying just because of portfolio management rules, because I did not want to have too much investment in the technology sector. And I had to cap it at one point, is Broadcom. The ticker is AVGO. So AVGO, kind of crazy, but that becomes that comes from a previous merger. So Broadcom grows by a lot of acquisitions. They are making RF filters in the smartphones, improving connections, and now they're very big on making semiconductors for AI. They sell a lot there. There's a big growth vectors, so they have multiple growth vectors. They're an amazing company, and of course, it trades at a premium because of that. Still like Broadcom, still kicking myself for not buying it because I've been talking about this one since 2016. And yeah, always been overexposed to the technology sector. So I had to make choices. And maybe one day I'm going to add it to my portfolio, but I would not hesitate today if it was not of having a good concentration in that sector already.
So, in the end, Mike, what's the right price? How should investors do it?
So yeah, so the right price, as I said before, a lot of investors are going to say wait for like the stock to drop at $45, and maybe the right price was 43 and 22 or 47.35. We're never going to know. So the right price is you invest when you have money, and that makes it so much easier. You have this option, or you have the option of taking your crystal ball. Mine is broken, not under guarantee, so I cannot use it anymore. So I've been calling for a recession for 3 years now, so I might as well just buy and stay invested. It's a lot more profitable actually, and makes a lot more sense. I've been doing this since 2003. I had a lump sum of payment in 2017. It was an all-time high market. The experts were calling for a big crash, 30-40% overvalued market. I invest all my money there. And even if the following year in 2018 we had a small bear market, at no time my portfolio went under $108,000, the amount that I received. So not in 2018, not in 2020, not in 2022. So the best time for that money was when I had money to invest, and it was at a all-time high market when valuation was crazy, and it was 2017. And today we all wish we could go back there to invest our money, because the past 8 years has been just wonderful, even though we had volatility. It's part of the market, but there you go. So do more work on the analysis, having spending enough time to write down an investment thesis that is based on strong numbers, and then the price to pay is the price to pay. You know, not too long ago, I had a member at DSR. He said, I want to talk about Stantec because you bought it at $107 in September of 2024, and it was almost like the perfect bottom for that stock. So the stock price was like going down. I bought it back then, and then price eventually went up, was up 30% when from the time that I bought it, when the member sent me that email. And he's like, how did you do that? Like, what's the trick here? And I'm like, well, I just got lucky. I mean, you know, I bought a very high quality company with a very strong dividend triangle. I did my research. I like the business model. I like where the company was going, and I just bought it. Now, whatever happens 12 months from that purchase point, it's pure luck on one side because it's a short period of time. It could have been the opposite. Stentec could have been like down 20%. That would have been pure bad luck because 12 months is nothing. It's going to be based on a strong investment process in the next 5, 10, 20, 30 years. But right now, it is what it is. So I had money in my portfolio. I wanted to invest in a stock. I had my eyes on Stantec for a while. So whenever I did those transactions in my portfolio for management purposes, I just like, oh, I have money left. That was on my buy list. Let's buy it. I didn't even realize back then that it was on a slump, and it was trading around $122 not long before. I just bought it because that was the day the money was available in my brokerage account.
So, talking about stock price, we will hold a webinar on September 18th at 1 p.m. Eastern Time about stock price fluctuations and confusion. How can it help investors with their buy or sell decisions and global portfolio management, Mike?
So, usually you make better decisions when you have a structure. And that's the whole key. I hear too many investors doubting themselves, doubting the market, having dilemmas. Well, when you have a structure and when you have a process, you don't have that. So in this webinar, we're going to learn how to read quarterly earnings in an efficient way, how to analyze the dividend triangle to make the difference between market noise and market news, and have this framework where you can make those buy or sell decisions not on a hunch, not because the stock goes too high or too low, but having this clear process with simple rules. And then you're just like, oh, at the end of this analysis, I will know if I should buy or if I should sell. Not because you'll know the future, but then you will be able to have a justification why you have not made this trade or why you're making this trade. And having those justification, understanding what you're doing with your portfolio will increase your level of confidence. And confidence is key. When you have high conviction in your portfolio, you sleep well at night, and most of the time you're successful. So this is what we're going to help you get if you register to this webinar.
And after the presentation, there will be a 1-hour Q&A session where you can ask all the questions you'd like about the markets and also about specific stocks to Mike. Live seats are limited, so save yours now at thedividendguyblog.com/webinar. There will also be a free replay sent to registered attendees. I'll see you in the chat on September 18, 1 p.m. Eastern Time at thedividendguyblog.com/webinar. Mike, thanks once again for your valuable insights. Listeners, remember to save your spot for our upcoming webinar to avoid price confusion at thedividendguyblog.com/webinar. For our show notes and related content, visit thedividendguyblog.com/244. Do not miss any upcoming episode. Hit pause and the subscribe button underneath our podcast logo now to get notified. Until next week, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.